Welcome back to another episode of Built and Backed. Joining me today is Lindsey Mignano, who's based in San Francisco and is a go-to expert for startup founders, small business owners, and international companies looking to break into the US market. A former attorney at an international law firm, Lindsey now leads her own boutique practice, SSM Law, where she helps emerging tech companies navigate everything from formation and fundraising to mergers and acquisitions and commercial transactions. Lindsey, welcome to the show.
Thank you so much for having me. Happy to be here.
I'm happy to have you here, and especially because we have not had anyone in law yet on the show. So I think it'll be such a good fit to have you come on and share some really solid advice for our listeners. But before we dive into that, I'd love for you to share more about who you are and what you do.
Got it. So my name is Lindsey Mignano. I'm the co-founder of SSM. It's a women-owned corporate law firm serving primarily venture-backed early-stage startups. And right now, everyone's an AI startup, but generally enterprise SaaS and PaaS companies. And in this day and age, usually AI. We are predominantly at seed through Series B. So it's usually after a company has raised some money. Maybe they've worked with a big law firm on deferred fees, realized it was too expensive, and then came downstream after their raise to, access small law firm rates. So we are, I would say, of the attorneys that we have, most are ex-Big Law, with the exception of a few. And so we have the same similar practice areas, maybe not full scope as Big Law, but full scope enough for the early stage clients that we serve. So we generally, are like their outside general counsel. We help them with their raises, their commercial tech transactions, their patent and their trademark portfolio management, any kind of, employment transactional matters. And of course, every once in a while they get in disputes with their, former employees or co-founders or whatnot. And we help them get out of that hairy mess before litigation. So happy to be here. It's my ninth year of owning the firm. We bootstrapped it with no clients when we broke off from big law firms in 2016. So I'm happy to, still be in business as a small business owner myself. And happy to serve the clients that we do.
Oh, I love that. And I love that what you shared with what you do with early stage companies, you do a lot for them. And so I'm curious to hear, like, at what point do startups tend to seek legal counsel through you? Like, is it when they're getting to like a certain milestone, or when do you generally see that happening?
So I'm going to be the lawyer that says that there are so many good online incorporation services out there.
Mhm.
Most of our clients use Clerky, and I do not get paid by Clerky to say that at all. Some of them use Stripe Atlas, some of them use Cooley Go. And they're usually formed as Delaware C corporations, which is the standard vehicle, even still today after Dexit and all the press that surrounded that. But it's still very common for early stage startups to form as Delaware C Corp. And they do so online. And they may not come to us right away because it is still cheaper to form a company online than to hire a lawyer to do it, whether it's small law firm or big law firm. They usually come to us when they're about to raise money and they realize maybe they may have made some mistakes along the way that need to be cleaned up before that seed round of $2 million or $3 million. That they realize that other lawyers, like their investors' lawyers, are going to be looking at their books and their legal documents and poking holes, and they want to make sure that that's all buttoned up before they open the hood of the car. So that's scenario number one, and that's the most common. They usually evaluate us against big law. And
Mhm.
because our hourly rate is one third or one half of whatever the big law firm is charging, we normally will win that contract, right? It's this the other second most common is from big law directly. So we have a lot of referrals because a lot of us are ex big law. We have a lot of downstream referrals from big law firms. It's usually when a company's still really early stage, but they might have blown through their deferred fees
Mhm.
and the law firm can no longer extend them any more grace period. And so they'll say, hey, you know what? You really haven't raised that much money. Maybe you only raised like $3 million, but my bills are $1,500 an hour. You have to go to a smaller law firm or you're just going to eat up your entire raise working with this big law firm, right? And so those
Mhm.
partners will refer to us as lower cost counsel to help them do probably a significant enough amount of work if they're sending them to us because it's more affordable.
Yeah, that makes a lot of sense. And you mentioned something that I think is a good point that I'd love to dive into further, which is when a startup is getting ready to raise and they realize that they've made some mistakes and they kind of need your help with fixing
Yeah.
those mistakes and getting back on track. And so, would you be able to share what some of those mistakes might be or examples of what they are?
Yeah, so, Co-founder divorce is really common, even before a financing event. And so mistakes could be something like, hey, I promised this guy, I didn't put it on paper yet, but I promised this guy that I would give him 45%. I'm a solo founder, I'm 55%, he's 45%, my second co-founder, he's my CTO. We didn't put it on paper, but it's not working out. And I don't really want to give him that offer anymore. How do I fix that? Because it's in writing. It's either in email or it's in an offer letter or it's something. Even if it's not in a restricted stock purchase agreement, there's some written promise to give him those shares, subject to a vesting schedule, or in some other cases, the founders may forget to add that, right? So there's not even a cliff. It's just a promise of, you know, 45% fully vested, which is like the hugest walk back that you have to do, right?
Yeah.
So that's a really common mistake because people at the early stage, they're wheeling and dealing really quickly. They're not lawyers, they're not CPAs. They don't have, an understanding of what the legal terms are and why they have to have them and all that sort of thing. So they're doing that, they're finding their co-founders and they're doing that relatively informally over email, text
Mhm.
message, WhatsApp message, all discoverable, by the way, in case of a litigation, but it's all in writing.
Yeah.
Um, and they're making some promises that maybe they don't really want to honor because it's not a good fit. So that's really common. We do a lot of, unfortunately, we do a lot of early founder business divorce. It never goes to litigation because the money's just not there for it at that stage. It's usually something that can definitely be settled out with both people equally unhappy, which is the way
Yeah.
how you know it's a really good settlement when both parties are like, oh, I gave and took a little bit more than or less than I wanted. So that's number one. Other cleanups can be like missed 83B elections, which are relatively
Mm.
routine synthetic 83B cleanups if the qualifications apply. Other cleanups can be, oh shucks, I issued more than I authorized when I went to do my online incorporation. So I authorized only 10 million shares, common shares in my universe of shares, but somehow I gave away 15 and I didn't have enough to even give
Mhm.
that away. Can you fix this, right? Um, those are the kind of most common ones when we see people doing things on their own for a while, that are like, okay, we understand. Like you've been trying to build your company. This maybe may not have been any worth anything to you until literally today, when you had your massive breakthrough and you got your pilot out the door or whatnot, right? So the attention to those things are understandably not going to be as intense as product, right? Or
Mhm.
platform build out. And so when they come to us, honestly, it can be expensive depending on how messy it is when you open the hood of the car, right? Clean up on aisle 7. And sometimes it can be very quick when we're just like, okay, we're going to attack it in 3 hours, it's going to be done, right? It just
Yeah.
depends on how much the founder and how long the founder has been without counsel. We've done cleanups where it's like 6 to 9 months of solo flying. And then we did a cleanup that it was like 8 years
Oh
of,
my gosh.
yeah, that particular company had a really expensive lawyer, so they never called their lawyer and they tried to do a lot on their own and they made a lot of mistakes. And it was 8 years of cleanup. And that was a very expensive bill. So obviously, legal is one of those things where you do it once, you do it right, or you pay a little bit more later on, understandably, to
Mhm.
take the risk of doing it wrong, right? You can always correct it. Well, some things you can always correct. Equity grants to third parties are always a little bit of a touch and go there, but most times most things can be corrected and a reasonable compromise found, right? And lawyers
Yeah.
can clean that up. It's always just going to always be slightly more expensive than just doing it right the first time.
Yeah, and I'm glad that you mentioned that part that most problems can be fixed, like you said, at a reasonable solution, which I think is probably providing some type of relief to any founder who's listening to this who may find themselves in that situation where they're like, you know what, I may have gotten myself in a little bit of a sticky situation and they may be hesitant on how to move forward, but knowing that any type of solution is possible, I think is a really good reminder. So I'm glad you
Yeah,
mentioned that.
I would say possible, but not always likable.
Yeah.
We draw the distinction there, like there are some things that, are fixable, but not to anyone's pleasure, when you realize there's a big tax bill associated with what you did, right? Like
Yes.
there are always things. I think that the most harmful mistakes are always the tax ones where you don't understand that it was a tax issue, that the way you did or structured the transaction caused a tax issue. And then what's really hard for founders is they're like, I just wanted to do this as like a handshake thing for my buddy so and so. And then they cause, a $30,000 tax issue. And they're always really upset because they had meant to do it informally anyway. But
Mhm.
doing it that way made it worse than paying someone to do it right. So,
Yeah.
hard conversations, it's never good to be on that side of the table as a lawyer because you're like, oh man, I've got to tell this guy that he did something wrong. And then I have to tell him and explain it to him in a way he understands it, even though he's not a lawyer. And then I have to tell him how expensive it's going to be to fix it. And that's the part of my job that I both love and hate because it's a wonderful intellectual exercise on a practical level, looking someone across the table and being like, hey, you made a mistake and now it's going to be $80,000 is
Mhm.
a hard conversation to have.
Yeah, but to the point you made earlier too, it's like it that is a really big expense now, but it's a good thing that you're catching that mistake now because that could snowball into double that or triple that further down the line if it doesn't get addressed.
Yeah, yeah, it's kind of like earlier is better than later, right?
Hmm.
The longer the baby's in the womb, the bigger it grows. It's kind of
Yeah.
one of those things. So, getting that fixed right away tends to end the bleed on the cost.
Yes, absolutely. And so you mentioned some mistakes that founders or startups might make when they're getting ready to raise a round. What are some business and financial metrics that they should have in place before they start to approach venture firms?
Right. So, honestly, these can change across vertical and across stage, right? So the business and financial metrics for a Series B life sciences company are going to be very different from a pre-seed enterprise software company. But for the sake of your
Mhm.
audience being predominantly pre-seed and seed, we'll stick to that. In the Bay Area, a lot of people are enterprise SaaS, and that's a big umbrella, right? That's a really big umbrella. That could include AI agent enterprise SaaS, that include fintech AI, everything's AI now. So fintech AI enterprise SaaS, that could include retail tech. There's just so much under that umbrella. But generally speaking, we see quite a lot of startups in Silicon Valley, here in our California office and out of Seattle in our Washington office, as enterprise SaaS or PaaS. And that tends to be the most common. Um, and there's reason for it. A lot of VCs fund enterprise SaaS or PaaS in Silicon Valley and Seattle at the early stage. It's a very popular vertical. So, with those metrics in mind and considering the audience, I would say, generally speaking, those rounds are down right now. In other words, there's less money that are going to those types of rounds. And then, of that amount of money, there's less dollars going to those rounds. So it's kind of a double whammy, right? So like
Mhm.
less deals and less dollars going to, Series A and below companies. But we're seeing a lot being deployed to B plus up the chain.
Yeah.
So what do you do, right? What do you have to show to raise a round? And what we're finding is that our most successful clients who are raising at this, especially at the seed level, when they're like raising, let's say a 3 to 5 million seed, they do have some revenue. It's they've already got their pilots out. Just a good handful of good enterprise companies, big tech, big co is what I call it for short. Those pilots have converted into paid annual subscriptions at some level. And let's say it's a 3 million, or 5 million series seed, you're looking at like anywhere from 500,000 to 1.5 million in ARR, depending on how big your seed is, right? And when we go to Series A, it used to be like a range of 1 to 4 to get it to 10 million Series A, and 10 million is being the health marker for a healthy market for Series A. Not this market, but in a healthier market, Series A would always begin at 10 million for
Mhm.
enterprise SaaS, statistically speaking. So we would see a range of 1 to 4, and I'm seeing a sweet spot right now at 2 to 3, so a little bit on the higher end of the market. Um, and those are with paid customers, annual subscriptions, with big companies, big tech, big co, ideally renewing on a certain day, and that whole annual fee being paid at once, not monthly or quarterly, right? Just to get the money off the streets. And that's really been something that our clients have been asked to demonstrate at an earlier stage since the heyday of 2021 and 2022, right? So since then, the past few years, we've seen early stage VCs asking for that. They want to see revenue. They want to see a level of traction, of stickiness where betas are converting and we're getting good customer feedback. And that's never always been the case at early stage, right? At pre-seed, which is the earliest of the early stage, and pre-seed can be called a lot of things. Sometimes people call it angel round, family and friends round. Regardless of what you call it, it's a round that say, let's say 600,000 to a million, and it's usually on safes. And there might be an inkling of, LOIs or betas or some kind of pilots that are like being thrown around and discussed, but they may not always have them, and they sure don't convert necessarily during that stage. And so VCs there at the really, really early stage might just be looking for, you know, the founder market fit, the idea that this particular founder has the connections and the ability to scale whatever they're doing right here at the pre-seed level into the seed level with betas, pilots, LOIs, whatever you want to call them, that
Yeah.
become paid contracts because maybe he really understands that industry because he used to work in that industry for that big tech company and he identified a need. And so there's more of an emphasis on founder market fit, I think, at that point, and less of an emphasis on like revenue and stickiness and traction that you would see at like a Series Seed or a Series A, right? But for the most part, I will say all are still struggling. The time between rounds, which used to be like 2 years, like maybe like 1.5 to 2 years, are now like 2 to 3 years. And we have some
Oh,
clients who even
wow.
in 2021, maybe 2022, that are still not, you know, going for their next price round because their valuation's not where they want it to be. They don't want to have a down round. So it's not necessarily the best market to raise in.
Mhm.
And I do think VCs have the pick of the litter, especially with so many AI companies coming out and being built left and right. There has been more selection around that too. In 2021, I think we had clients who had come to us just with an idea on a napkin and been like, I have a guy who wants to invest $2 million. I need to form a company. And you're like, wow, you haven't even formed your company yet. That is like
Yeah.
not the narrative today. The narrative today is I've formed my company. I have onboarded advisors. I am pitching left and right. How do I get this money? I'm so frustrated, Lindsay. Tell me what I'm doing wrong. And I think
Yeah.
that, unfortunately, is the not the fault of the founder. It's just the world in which we live in when the pendulum has swung in the other
Mhm.
direction right now.
Oh my gosh, you've shared so many good things here that I just want to dive deeper into. And I feel like it's a few questions, but it might all kind of get bundled into one. And so you mentioned a few things. One being that it's not a good time right now to raise. You also mentioned that the like seed and lower, series A and lower are getting like less deals and less money. And so I'm curious to hear like why you think that's happening, just from what you see with your clients and just all of the experience that you have in tech.
Yeah, up until this past year, and this past year has been better for
Mhm.
IPOs if you're tracking IPOs, since 2021. So now that's a lull between 2021, 2022, all the way up until like say 2024, 2025. We weren't seeing as many IPOs. We weren't seeing liquidity being returned to VCs in a really big way, right? In the kind of way that they need, which is that minimum 3 to 5x, hopefully 7 to 10er kind of return that you would get with a unicorn IPO. We just weren't seeing that liquidity in the industry. So after, the pandemic, after the Ukraine war started, we saw a lot of VCs being like, okay, what am I going to do? I'm not getting liquid from these IPOs. This could be a wartime situation. I'm going to pour more of my money into later stage to hopefully, shore up the companies that I've already invested in because I don't want to lose all my investment, right? Like they need help after the
Mhm.
pandemic, and then they might need help after we continue to go to war and geopolitical things are where it is and there's no exits. We need to preserve our portfolio. And so there was just less, being deployed, especially today in 2024 as well, just to that pre-seed seed series A when it comes to institutional money. And I think it was because they were trying to save other money that they've already invested in, right? So that those companies can possibly IPO or do a secondary or in some way exit. I'm not saying all exits are great exits, but in some way exit to get some money into their hands, right?
Mhm.
So we have a little bit of that dynamic there that's affecting and trickle down towards, the early stage. And it doesn't always hit at the beginning. I think in 2020, when the pandemic first happened, everyone was so worried that early stage was going to be impacted. And it took a while for early stage to get impacted. If you remember, it was public market volatility here, and then all the later stage startups valuations went down. It was this very much like, oh, what are we going to do about later stage companies? And we still found that, at the earlier stage in 2020, 2021, it was still doing good. It wasn't as impacted. It just takes some time for that public market volatility and the valuation depression at late stage and growth to kind of make its way down. And now it has. I think it really has. And so we are noticing a filtering effect where certain founders of certain verticals who have certain connections and live in certain places are getting funded, and they're not just getting funded like the regular amount. Instead of that VC giving $4 million to, like, 10 early stage startups, he's just giving that one guy, or usually it's a guy, unfortunately. And we talk about that differently on different podcasts, but it's usually a guy. So he's giving
Yeah.
that one guy, that deep tech what founder in AI, or that life sciences founder. He's giving them all in there, all that bucket. And so, that is something that's really interesting as a response, right? Because um, that means that the median goes down for everybody because really it's just that one guy. And the deal count still remains low.
Hmm.
But that one guy is having the best time of his life. So it's this have and have nots, where some people on our docket are just telling us, like, hey, like, I am just floating in it. I am oversubscribed on this round. I thought I was going to raise 10. I raised 15. I don't even know if I need the extra five. Warnings about that separately. But like, they're oversubscribed. They're getting hit up by everyone. And we have other guys who are just like, I can't get a second meeting with anybody, and I don't know why. And I have good revenue. What's going on?
Mm.
And that is an interesting, dynamic in the market. Um, and I would say, it's something to be concerned about, especially if you are a founder who's like not getting callbacks, but are showing revenue. Like, where to take it from here is always the question that we get asked, like whether to wait it out, um, whether to try something different, whether to become a small business, which, by the way, there is no shame in being a small business. There are plenty of them, plenty of bootstrapped, very profitable, small businesses that use other alternative forms of financing outside of venture capital to become very wealthy people.
Mhm.
So it's possible. And I think that we're going to see more of that since we have this bifurcation.
Yeah, and that's a really good point, is like encouraging founders to think about, well, what's the next step? And then it's not always the end all be all, despite it being, of course, very frustrating to be in that position when you feel like you're doing everything right and you have the numbers to show, but you're just not getting the funding like other startups and other founders are.
Yeah, and I think it impacts people differently, right?
Hmm.
I find that female founders struggle with it more, in terms of, when we have these panels, and we speak to large groups of people, and we talk with male founders versus female founders who are circulating the room. Um, you know, Solo female founders have a really, really tough time, more so than male solo founders. I mean, solo founders of everything have a tough time getting venture capital. Something like 16 to 19% of venture-backed companies are solo founders. So they're still a very, like, one-fifth minority, if not less. So they're all solo founders have a hard time, but solo female founders have an especially hard time. And there's a lot of bias, right? But there's also just the practicalities of fundraising when you're doing everything yourself. So I think it's founder specific, whether regard if you have like one or two founders, you have some help on the team. I think it's location specific. There's more money that goes out of Silicon Valley, like times 10 or 15 than any other place. The next one is usually New York or Boston or LA, right? But it's far leaps beyond. And I heard something, from a VC on a panel once where he quoted like 80% of the venture dollars that are being deployed from Silicon Valley venture firms are being deployed to local, like, startups in the ecosystem who are headquartered here. Because there's Cal, there's Stanford, there's Santa Clara, there's tons of universities that are spinning out great folks from business school or just engineering departments that can build things and build them really well. And so, a lot of that is being concentrated, in the select few in this very lucrative environment called San Francisco Silicon Valley.
Yeah. And that's a really good point that you mentioned about it might just be honestly location specific. And so that makes me curious about one thing that I'd like to know is that for your clients that you work with who are really successful startup founders, what differentiates them from others of being able to get that funding?
Yeah. So one thing that I think they really do well, and this applies to foreign founders too, foreign founders who come from Germany or Switzerland or London or Paris, and they live here. They physically move here because it's important for them to understand the ecosystem. I think those folks that are really raising in a good way at seed, especially seed, pre-seeds, everyone's a little bit of a it's a toss up. So there's more variation there. But at seed at enterprise, you're seeing, really strong founders who have researched the venture firms by stage and by verticals. They're approaching the right people who understand the landscape of VC. Like they know the difference between a CVC, a venture firm, and a family office, right? They know what an angel syndicate is. They understand how angel investors and pre-seed VCs and seed VCs may all fill around. They understand how the round works. Right. And that's basic business understanding that I think you can only get by kind of immersing yourself in a world where that is just second, nature. Like
Mhm.
in, I'm from Hawaii originally. This is not what Hawaii does. I'm from an agricultural family. In San Francisco, I can like toss my bag over my shoulder and hit a few VCs along the way. There are just so many here, right? They're just walking the streets. They're people you went to college with. They're your husband or your wife. They're your brother-in-law. There's so many of them. And there's so many lawyers and CPAs and founders who all are in the early stage ecosystem who can make that connection really quickly for you. So it's having those conversations at dinner, at coffee, at lunch, and you can be at a cafe here in San Francisco and just hear some founder pitching a VC and hearing the feedback that's coming back. 'Cause it's again small real estate, right? So you learn a lot more because you're just in it. Um, Another thing I think they do really well is they they understand the optics of the VC, right? So like we have very smart seed clients who are like, I am going to choose this VC not because the terms are like slightly better in the term sheet for my Series Seed or my Series A, but because this one's a real player in the space. So that's even bigger than just differentiating on vertical and when you invest, right? Like it's more so like this VC has the connections to get my company into big tech, big co-partnerships and has already made 3 introductions and they're right in my vertical. That's exactly my target client. I know this guy knows it. I know the firm knows it. And that's a really sophisticated play. That's something that I wish more of our clients had because I think sometimes when you don't have money, you think all money's good money, right?
Yeah.
If anyone's trying to give me money, I'll just take yes to money. And you do so with that attitude because you've had no money for so long that you don't really have the discernment to be like, or the discerning eye to be like, why this money and not that money? What's the strategic value of this firm and not that firm? And then, of course, what happens if I do choose a large agnostic, vertical agnostic, stage agnostic venture firm, if I choose that one? And I don't choose the small, only invests at seed and series A, vertical specific firm. If I choose this one, what's the downside? What's the upside? And the downside that we've seen play out since 2021 for a number of our clients is that if you're large, vertical agnostic, stage agnostic venture firm does not follow on, they lead you around at seed and they don't lead you around at A, it is a signaling effect to your new money coming in the door. And it could be for reasons that have nothing to do with you. It could be like you were an AR company and now they just want to invest in AI and it's just not the right vertical for them anymore. They changed their thesis along the way, right? Um, but the optics look terrible versus if you were with that seed stage venture firm that only invests at seed and series A, right? Or maybe they only invest at seed and they don't follow on at series A because the fund's not big enough, right? Then if they don't follow on to lead your series A, there's no optics issue. And I think the founders who understand that level of dynamic because they've been so inculcated with the industry, having conversations with other founders, with their lawyers, with their PEO providers, with their bankers, all of which have had some anecdotal experience, um, is really like those are the guys that are really doing well. And they usually are in Silicon Valley only because there's so much of that conversation that like dominates like the discussion versus if you're in Honolulu, Hawaii, that's not the industry. You don't know a startup banker, startup lawyer, startup CPA, startup founder, startup VC, like then you're going to be naturally less educated on the topic unless you go out of your way to artificially chat GPT educate yourself purely on like word only, right? You're not going to naturally get it because no one's going to explain it to you over a casual coffee.
Yeah, and I love what you shared there about just the importance of like immersing yourself in the community and in the area so that way you have a solid understanding of all these different avenues to consider because it kind of sounds like what you're alluding to is that more money isn't always a better choice. If you are going for more money with that agnostic VC compared to the VC who might be offering you a smaller amount of money, but like you said, have deep expertise and deep knowledge in the vertical that you're looking to go into.
And also the the follow-on issue, right? Like you
Yeah.
take money from the big agnostic VC, even if it's the same amount of money between the two firms, it then you better make sure that that VC is happy with you at the next round and the following round because they led you at seed and they have the ability to lead all the way up to blah blah blah. So if they don't, it is a signaling effect to all your other VCs. If they tell you, "Hey, listen, you're just not meeting your milestones. I don't want to invest at Series A." It's really hard then to go and get new money and explain why that vertical agnostic, stage agnostic VC won't lead again, right?
Yeah. Yeah. And that makes me wonder, is there a way for founders to know if their VC will end up leading the next round before they have the first round, if that makes sense?
So most of our founders do the research, right? Like the
Mhm.
firm, there are so many different platforms that you can go on, but you can see this is the venture firm. These are the types of companies they invested in. Here's the verticals they've invested in. You can see kind of have an idea of whether they lead or follow in that round and what stages they're at and what fund they're on. Are they on fund one? If they're on fund one, it's probably an emerging fund. It probably is 50 to 100 million. It's probably pretty small, even for the, the emerging funds that are, bigger of the funds. They're not huge. They're just like three people and they mostly cut seat checks. So you can kind of figure that out. But if you're dealing with a fund that has like 20 or 50 employees and an office in Barcadero Center, and their companies are IPOing and they're on fund seven and they've been operational for like, so many, then you can kind of have an idea of like where they would sit on where they deploy. And as a founder, the last thing you want to be doing is talking to a guy who doesn't invest in your stage, even if it's
Yeah.
your vertical, and he just shuttles you off to seven other guys who might be interested, like spending too much time with that guy, although the meeting's great and the referrals are great, but spending too much time with the guy who doesn't invest in your company at your stage is a waste of a founder's time. And have a lot of founders spinning wheels because they're not just doing the basic due diligence on the website.
Yeah, and that is a really solid point is to just like do some research because a little bit of research can put you in a better position if you have a knowing of what's to come or what your chances might be of being able to get funding and whatnot.
Absolutely. We tell them to make an Excel sheet. Like, I think the founders that do the best with regard to their sales do tend to do the best with regard to their raise. It's the same process, right? It's identifying a lead, figuring out who the point of contact is, tracking the follow-ups, whether it's in your CRM software or something else, and having the meeting and closing the deal. It's a very similar process. So when we have founders that are good at, converting pilots to paid annual subscriptions. We know, like, okay, that guy's organized enough to do that process. When he goes for his round, he's going to be really organized. And usually that same person will have three term sheets, three proposals, right? Because he's already been, stoking the fires now for 6 months, delivering potential investor email updates. And so he's already teed that up for close. And when he's going to say he's going to raise like, mid-October, he's going to raise mid-October because it's already been done. It's an organized process.
Yeah, yeah, that makes a lot of sense. And with the advice that you've already shared, which has been so good, I have to say so far, I would love to hear if there's any other advice you'd give to a pre-seed or seed founder who's looking to raise in the next year.
Right. So I would say one thing that we didn't discuss that could come up in your raise that you may want to avoid, being distasteful is legal and financials. Uh, Getting a good bookkeeper. I don't do bookkeeping, but getting a good bookkeeper, making sure that, all of your expenses are allocated accordingly in the various categories and you have clean financials, making sure that all the customer contracts that you've advertised as converting and paid are all somewhere in a VDR, right? Because that you need to prove up the number that you just told these VCs you have. So you need to make sure all your contracts are there. Um, Number three, legal as a whole, for the most part, at pre-seed and seed, less so at pre-seed with regard to the commercial contracts aspect, but for both pre-seed and seed, just the basic hygiene of the company corporate-wise, making sure that every grant on the online cap table, and there are so many, right? There's Cake, there's Pulley, there's Carta, there's Stripe Atlas, there's Clerky. They all have online cap table options. I don't care necessarily which one you guys use. I hope that you use one, and then I hope that it ties out, which means that every grant has a stock certificate assigned to it. That founder or employee of the company has assigned their IP to the company via a CIIA or a PIIA that accompanies the RSPA. Just stuff like that, where you're like, well, that seems easy enough. Like I've got them all somewhere. But getting it organized, in preparation for another lawyer, a good one too, from probably a big law firm who represents the VC to come and open the books and say, okay, does everything tie out? Are all the grants supported with documents? Do they all have the right 4-1 vesting schedules? Although there's arguments for 5-1 or 6-1 these days, and I hear them. They're compelling. So the relevant vesting schedule for your industry and your vertical, right? Usually it's 4-1. In some other industries, it could be 5-1 or 6-1, depending on where the milestones are. Is everything signed? Did everyone turn in their 83B elections on time? Did everyone assign their IP to the company? If you have a co-founder separation, did that guy sign a separation agreement on his way out? To not sue the company and to verify that everything he created while he was here belongs to the company. Just stuff like that. I would say founders who can get that done contemporaneously, awesome. But if you can't because of affordability issues or, budget, like lawyers understand that, but then we're just going to do cleanup in aisle seven. And that should ideally be done optics wise before you give your venture firm's lawyers the opening to your VDR. The reason why is because if, first impressions do matter. And if they open something that you've done and they're like, wow, that's terrible. You're terribly disorganized. And you didn't know to elevate something that you don't do for a living to a bookkeeper or a CPA or a lawyer. It's a judgment call. This
Mhm.
guy thinks he can do it himself and he did it terribly. What else can he do himself that he'll execute terribly when he could just pay someone dollars to do it, right? So there's some discretion that you have to employ. And I tend to tell people, like, if you can afford it, get the books and the financials and the corporate documents on the legal end and the bookkeeping tax end all cleaned up. Make sure you're all paid to date on your state, federal, and franchise taxes before you open up the VDR. We do get called in because venture firms will open up a VDR and be like, this startup's idea is great. They are terribly disorganized. Lindsey, come in and fix this. We'll refer you the client, right? And we'll see it. And we're like, wow, kind of bad mistake because now this venture firm is like second guessing a little bit whether this
Yeah.
guy has the right discretion, right? And there is so much discretion because they're only investing in you at pre-seed. So exercising the discretion to know when to rope in the right people, I think is a really, really EQ metric that I think a lot of founders, if they had more of that, they would rope us in a little bit earlier.
Yeah, it makes me think of the whole idea of like you don't know what you don't know. And so that's why it's so important to bring in the person or the people who do know that stuff. So that way it really sets you up for success in the long run. And like you said, doesn't kind of give those VCs pause or pushback because now they're kind of having some flags that are being raised with some things that they're seeing.
Right. And it shows that the founder has the humility and the self-introspection to understand where his or her their skills end and someone
Mhm.
else's begin. And I think that's a really important thing for a founder. That's something that I think, we don't talk about enough about founders who are self-aware, who've done the personal work to understand, you know, what they'll tolerate as a founder, what they know as a founder, what they absolutely won't tolerate as a founder. A lot of our founders are kind of on that journey. And then there's conflict and they're always very surprised. But, going through that self-awareness and understanding where your limitations are and what is the best use of your time, I think is always a great exercise.
Absolutely. And I'm curious to hear what verticals you see a lot of early stage venture capitalists investing in today.
Right. So AI is a very popular vertical. In 2021, we saw a lot of like generative, and now it's kind of switched to agentic, and we've seen a lot more agents coming out. Enterprise SaaS and PaaS are still really favored, but I would say um, since this new administration, there has been somewhat of a shift in terms of like anything that the administration kind of prioritizes, like crypto, for example, or defense tech, or um, those are going to do especially well, right? Um, our clients who are raising the biggest at the pre-seed and seed are usually enterprise companies. They're usually AI companies, and then they're usually in a very subset vertical like deep tech or hard tech. And people are always like, what does hard tech even mean? Like people get deep tech, right? Hard tech is like, it's usually like a software as a service with a hardware component, right? They work together in some ways. It's really capital intensive. Like it costs a lot of money to make it, like a robot, right? Like a robot that has an app component or something, like the AI moves the hand or whatever. You can control it from your phone or however there's like software, but a hardware component. And those are the ones that I think, are really interesting and we're seeing more of, aside from the just typical onslaught of agentic enterprise software companies with a SaaS or a PaaS, right? Um, and then I've seen some other ones that are like really out there that are consumer. And I don't have a lot of clients in the consumer AI space, but we do have some. Um, and that can be more like fintech, consumer AI fintech. It has done pretty well. Those are where, that intersection of consumer and AI and financial, regulations can get really interesting from a legal perspective, but also we see VCs funding that.
Yeah, that's really interesting to hear. And it actually perfectly relates to my next question that I'd love to ask you, which might be a tough one for you with how many people you know and work with. But I would love for you to give a shout out to someone who's doing something cool in tech right now that you really admire and is really inspiring you lately.
Yeah, so I want to shout out Peter Walker from Carta, only because, and Carta does not pay me to say this, um, because I've been following his LinkedIn ever since, he came to be. He's a statistician of sorts, right? He's their storyteller. And Carta has amassed, as most cap table, services will eventually amass a lot of data on startups. And he came out with, a post maybe at like beginning of 2025 summarizing data on the solo founder. And he's been very vocal about how there are more solo founders today. For example, like his stats looked at something like 45,000 startups between a 10-year period-ish from like 2015 to 2024. And, in 2017, 17% were solo founders. And then in 2024, 36%, were solo founders. But what I think is really interesting where he's pushing the needle, and I do tend to agree with it, is that AI is making it even easier to build a company these days. We have now, for the past few years, we had excellent fractional help. So if you were a business founder, solo founder, and you needed a CTO, you could hire a CTO by the hour, right? And not have to pay them any equity, right? They could build out the platform for you. You could literally pay an engineering firm or an outside CTO firm to do it. And there's tons of them out there. But now we also have, on top of that, we have AI, right? So the case for the solo founder becomes more compelling. And he's been arguing this in some of the stats he's been publishing recently on his LinkedIn profiles. And why I find this so interesting is because we have so many solo founders at SSM, and all of them struggle to get financed, whether it's a female solo founder or a male solo founder. It is still a struggle because VCs will tell them, some VCs, not all, but some VCs will say, hey, would love it, just if you had a co-founder. And that's a security thing, right? They're de-risking something. If like you are walking down the street and you get hit by a bus, we at least know the other guy's alive, right? And he can carry the company because it's so morbid, but it's the worst case scenario that everyone thinks about. We have some insurance that it's going to live, the company will live. Or there's just a technical skill that's missing, and usually in that case, it's the CTO that's missing. But we do see a lot of pushback there. And then, as I mentioned before, it's less than 20% that of, venture funded companies that actually have, just one founder. But what's really cool about the data that Peter has been sharing recently this year is that they're on the rise, AI is on the rise, and we might be hitting that tipping point of interesting developments where solo founders can build things out much more cost effectively, faster, perhaps without giving away, the 45% to the second co-founder that they normally would give away. Um, you know, and then what? Will VCs remain skeptical of solo founders, or will AI, especially if it reaches AGI by 2030 or whatever people say, will that will that obviate the need? Could we see more venture-backed solo founder companies? And I would like to hope that we could, because I think there's so much room for AI to really show ROI, hopefully soon, in a meaningful way. And there's lots of debate onto whether or not it does now or it could by 2030. But if it can, then do we really need two or three co-founder teams to start? And can that be a less expensive way for the solo founder to do business? So I think he's doing something really cool by pushing that needle, pushing that envelope, and needling that issue because I think it's one that's worth more discussion.
Oh yeah, absolutely. That was a great shout out. I'm gonna have to check out his content now because now I'm interested from what you've shared.
Yeah, and I think cap table management platforms, whichever they are, the data that they are collecting on startups, everything from what they raise to when they raise to how they pay people in equity and whatnot, it is compelling. And it's really giving a lot of founders who may not have access to anecdotes from a lawyer or a CPA because they can't pay for us yet, it's giving them free information about what their colleagues are doing. And it's taking something that was always behind these gated, academic walls of, oh, I work with, Wilson Sonsini. It's a huge law firm. It's got tons of clients. Of course they have data, but now it's free and it's accessible. So more founders can be um, competitive, knowing what their peers are doing.
Oh, absolutely. Lindsay, this has been such a good episode, and I've so enjoyed having you on the show to share everything that founders and startups need to know when it comes to all things law. And I'd love to have you share with our listeners where they can find you online in case they'd like to connect.
Yeah, sure. So I'm on LinkedIn. That's the easiest way. I'm on all of them. I'm on Instagram, I'm on Facebook, Meta, I'm on LinkedIn. LinkedIn is probably the easiest. You can message me there and I'll, get back to you. And that's most likely the best way to get in touch with me.
Perfect. And I'll include your LinkedIn profile in the show notes that way listeners can easily find you and connect with you from there. But thank you so
Great.
much again for coming on this week's episode of Built and Backed.
Yeah, thanks, Ashley.